Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500 doing a 5-minute stock analysis. Today we have AES Corporation. This is my first 5 minutes of due diligence on ticker AES. Let's dive on into this company. So it appears that this company is an independent power and renewable electricity provider. Sounds like utility company. Operates diversified power generation and utilities, so I was right on that. They own and operate power plants, generate and sell the power to customers such as utilities, industrial users, and others. Standard. Looks like they use a range of fuels: natural gas, coal, diesel, oil, including hydro, solar, wind. So looks like a general utility. It's not like they're focused in one single area. They own and operate assets of 30,000 megawatts in U.S., Puerto Rico, El Salvador. So it looks like U.S. and South America. They have Europe and Asia, so all around the world. Formerly known as Applied Energy Services and AES for the last 20 years. So let's dive on in. Utility company. This could be interesting. I expect to see a lot of debt. Usually their returns on capital are low, so they need debt in order to make the return on equity high enough, but we'll see if that proves to be true. The beta is 0.81. I like that. Again, I'm looking for under 1, but share turnover is 170%. So again, you don't have a stable shareholder base. That makes it less likely for long-term compounding, but who knows? So return on invested capital. First thing I see is we're up and down a lot. There's might be some stability here. You're kind of in a low range, but you have quite a few loss years. Let's see how many years you're losing money. 1, 2, 3, 4, 5, 6. 6 years of losing money in the last 20 years. It's a little higher than I'd like. If you lose money in 1 year every 10 years or 2 years every 20 years, that's okay. But ideally, I want you to make money every year. 4 out of 20 is kind of high, and then their return on capital never gets that high. It looks like the highest in the last 20 years is 5%. So in order to make money as an investor, I need a return on equity of 15% is what I think I need for a long-term hold. So they would need a lot of debt to make this work. But when I go to the 10-year median returns, I immediately see they don't have this figured out. The return on equity is only 1%. So if they are using debt, it's not providing the leverage they need to be successful. And then the 10-year CAGRs tell me this is a declining business. Revenue's dropping, assets are dropping, free cash flow is dropping. Now it says EPS is up, which is good, but this is a declining business, and so you might see earnings rise a little bit over time. Sometimes companies that are in slow liquidation can have rising earnings. So the first thought then is this could work as an investment, but you're going to want a really low valuation. The problem I see here is a PE of 27. So I don't know if this number is accurate, but I mean, let's just quickly see. So it says they earned 7 cents a share in 2022. You're trading at a 22 close. So I don't know how those numbers are working out. This might be an inaccurate number. Price to sales of 1.4 or 2.6 for book value is not terrible, but it doesn't scream cheap, especially because your margins aren't very high. So it seems like it's probably overvalued. Again, I like to buy PEs under 15, but this PE might not be accurate. So to dig in a little bit more, let's go look at the income statement to see how this is breaking down. So gross profit, was 4 billion in 2011 and has dropped to 3 billion or under 3 billion. So basically it's a declining business on gross profit line. It's a declining business on operating profit, and it's basically all over the place on net income. What we do see that looks good finally is your shares have declined. So you started out at 778 and now you're down to 665. So they're not just diluting and diluting and diluting. That's good news. Maybe cash flow. Well, no, I want to see balance sheet. How's their debt situation? So they have 34 billion in assets and they have 29 billion in liabilities. And so that's 18 billion is debt, long-term debt. So basically half the balance sheet is debt. It's pretty high, but again, you kind of need that in this style of company to make a profit, but they're clearly not making it work. So let's look at the cash flow statement. So now this is a good sign. Cash from operations is all positive. You basically have at least $2 billion, well, besides 2014, of cash flow from operations every year. So despite the fact that they lose money, they are cash flow positive. So it's not like this company is going to just go bankrupt overnight. But look, they're having to dump all of that cash flow from operations is going into PP&E. So they're having to it's very capital intensive, and they're not making an economic profit for investors here because it's all having to be reinvested. You can see they're not able to pay out much, if anything, in dividends. They are paying some, and they have some issuance of debt there. So to me, this is a pass. Utility companies are always going to be a hard buy for me just because the caps on the return on equity they're allowed to have. But definitely a pass for me because they can't earn enough money for me to make money. They're losing money in periodic years, and they're just not making profits. So don't forget to like this video, hit that subscribe button, and go ahead and click on the bell in order to get notifications when I upload new videos. Thank you for listening, and I hope you'll join me next time.